Good afternoon, everybody. Welcome back to Schwab Coaching for the next topic, getting started with stock investing. And today in this series, we are discussing the how much to buy portion of the trade process, everybody. If you have been privy to prior conversations, you have seen us discuss the what to buy, the potential for when to buy, and today is the how much to buy. So a real fun discussion around proper position sizing, how we do the math on such things, and a few examples for you today as well. So I'm pleased that you're all joining me today. Say hi to Ben Watson there. He's managing the chat for us. He's gonna certainly manage to respond to questions that I'm unable to do so with in the moment. But I am going to try to keep an eye on things happening in the chat to bring your questions into the discussion. I'm happy to do that for you. And so I would love to hear and see those comments in there, everybody. So feel free to post for the 45 minutes that we expect to be live here today. Again, I'll remind you all that we have an archive for this segment. It's available on the Schwab YouTube coaching channel, that is, under the archive. So feel free to reference old sessions of this class if you'd like. This one will be archived as well. Typically, we get this up for you by the following morning at this point in the afternoon, but you will have it available to you. There might be a good one to bookmark. In fact, bookmarking those preferred watch lists is a really good way for you to keep apprised of newest classes that we've added there. Not to mention, you can also, of course, be subscribed to said YouTube coaching channel. We'd love to have that subscription from you all as well. So with that, last thing, follow Ben and me on X, Ben Watson CS and Kevin Horner CS. And now let's get into the disclosure so that we can start talking about the good stuff here. So remember, of course, that our conversation is only informational and educational. We do not make any recommendations nor endorsements of a particular approach or strategy. Today, I will be giving you ways that some traders look at approaching the process of building their trades, the amount of dollars to devote, the amount of shares to be purchasing, etc. But beyond that, please just consider everything we cover to be educational. We will talk a lot about technical analysis when we look at these examples, by the way. And remember to consider technical analysis just a piece of the puzzle. We encourage you to make decisions on a multitude of factors as opposed to just one thing specifically. Now, I noted this is a series, everybody. This is some of the topics that we have taken on the process of addressing here in this session. Again, we are live on Thursdays at 3 p.m. Eastern, but you can go back into the archives, find older conversations here, and this is what you can expect as we continue on forward with the series itself. And today specifically, we're going to discuss risk and emotion, a couple of things I'm pretty familiar with, definitely familiar with allowing my emotions to get the better of me as it relates to trading. And I feel that it's one of those things that we traders have to get a grasp on. We have to not only recognize that our emotions play a part in things, but we have to recognize methods available to us to reduce those emotions, to tamp those down, to help us in making proper decisions. So I'm going to give you some concepts and ideas today that I think will be helpful for that. And like I said, we will be looking at specific examples to take all of the pieces of the puzzle that we'll be highlighting today and putting them to work in examples in the wild, I like to say. So we'll certainly be looking at the Thinkorswim desktop platform as we do that. So let's jump right in, everybody. Let's start off by talking about managing risk. It is a boring topic, right? Nobody wants to hear about managing risk. However, I'm a big believer in not just thinking about risk, but utilizing it to our benefit. And we want to start our process often by thinking about risk as the worst case scenario when we step in to our individual trades. And I think that's the thing that might be hardest for so many traders is saying, well, why would I consider stepping into a trade and looking at the worst case scenario? Isn't that using, negative emotions and allowing me to overthink things? Not at all. In fact, when we start talking about investing and putting our money at risk, the key to putting your money at risk is recognizing that risk is inevitable as it relates to the equities market. And so we want to use the knowledge of risk to properly enter our positioning. And so what we're going to be talking about today is the process that traders might encourage or might consider, I should say. We're not talking about a process that differs from trading. So we're not talking today about risk management and risk mitigation through long-term investment strategy. That's a very different conversation. So let me just make that quick point. If you're thinking about this class in particular, it addresses almost exclusively the process that an individual who says, I want to buy this stock and then I want to set levels where I'm ready to be a seller of said stock, whether that's below the market or above the market value is irrelevant. The point being, if your goal is to buy a stock so that you can sell it later, whether it's days, weeks, months later, that differs quite a bit. And if you are an investor who is simply putting money into the marketplace on a month, like maybe it's a paycheck to paycheck, month to month basis in your retirement assets, those are not scenarios where you want to incorporate these types of strategies and concepts. You diversify and mitigate risk in a long-term investment portfolio through diversification of your assets, right? Owning large cap and small cap and international components, cash and fixed income components, diversity amongst the US market through investments in the various sectors of the market, right? So there's a lot of different ways to do it from a very different standpoint, but today is exclusively on the trading aspect, all right? Now, risk management as a trader, it is paramount to our success. Further, we need to recognize as traders, we're going to take losses. Losing money on a trade-to-trade basis will happen. And if you're not willing to take losses in a tradable account, then you might not be a trader in reality, okay? So think about this commonly, about the need to recognize that you will take losses, and then just recognize that you are one of many individuals trying to be active in the marketplace and incorporating some strategies that are going to hopefully help you take small losses for the opportunity to make bigger returns. So there's a process to that. Everybody says they want to buy low and they want to sell high. We want to sell our losers quickly and let our profiting trades run as long as possible. These are all fairly high-level concepts that I'm certain many of you have heard about. But that doesn't mean you have built a process necessarily just yet. So that's what we're going to really get into. Enforcement of a sell discipline, the recognition that the prices have traded to a level where you previously stated you're no longer comfortable and moving on. Or, hey, I said I was going to sell if I achieved this profit level. Now I'm going to allow that to happen. Not changing your mind midstream necessarily, but incorporating strategies that will allow you to maybe exit if things can, maybe continue to participate to the upside, but exit if things reverse course or if the trend of the existing position changes. So when we talk about this concept of a sell discipline, we often as traders are incorporating things like stop orders to exit those positions as the price of the stock is moving lower, So we're going to talk about that as well. Now, I've said it previously. I'm just going to reiterate the necessity here that emotions are your enemy as a trader. And so leaving those emotions out of your process is ideal if you can do it. Ego can be a big part of this too. Don't let your ego make your decisions for you. Try and check your ego at the door, right? You might even find, and some traders do, that having a very clearly defined list, and not just a list, but a physical series of bullet points in the vicinity of their trading platform can be very, very helpful to them. Just gives them the framework. I often reference this effort of giving yourself a few steps. This is really your playbook to success. You can be detailed with it. You can be fairly generic if you prefer, but the more detail you give yourself, the more prepared that you likely are. If you are building a playbook for how you want to address an individual trade, well, hopefully that means that you know absolutely how you're going to act if the stock goes sideways for a few weeks, if the stock rallies quickly 10%, or sells off quickly 4%. How are you going to act? Where are those levels for you? And not just, hey, if it sells down X percentage, I'm going to move on. I want you to set levels and put them on your positions in the charts. I want you to know definitively what is stated as, and whether it be notes on the chart or notes in your actual physical notebook. All of these can be wonderful ways for you to make decisions in the moment, which is the hardest thing to do if you're ill prepared. I mean, I just ask you, how many of you out there who are, some of you who are very frequent viewers of these shows, I've seen many of your names before. I've recognized quite a few familiar names and faces here. But how many times have you put yourself in a trade that you did not conceive exit strategy, whether it was to the upside or the downside? And did you find yourself maybe you found yourself in a winning position rather quickly? Was that easy to manage? Sure, it feels good. But did it feel good because you got lucky, or did it feel good because you happened to use the proper process and things went your way? Bit of a different viewpoint there. So I'm a believer that we must conceive of this stuff in advance, and that way I've already got that roadmap to success. The roadmap that tells me, you said if this was going to happen, you were going to move on, or you said if this was going to happen, you were going to do this. Maybe that's adding to the position. Right? Recognize you're not lying to anyone. The market is not your adversary here, right? The market is the market. The market is, one way to look at it is the market's always right. Now, you might not always agree with the market, but the market is often considered right. And what we are trying to do is understand those machinations and use them to our benefit. That's what traders are really trying to accomplish here. So, there's the benefits of risk management. Our hope is that they aid us in being better, longer-term, more consistent traders. The key is being available to stay in the game as long as possible. And that means management of our capital that we use to trade. You guys, some of you are mentioning it, confessions. Yeah, guess what? If you don't know who you are as a trader, it's going to be more difficult to trade. If you don't recognize that you're a trader who's prone to certain areas of making mistakes, I know I am. I definitely learned that I'm an emotional trader. It was one of my hardest things to get through. But these are the steps that we can take. Hopefully, they can aid us in just being more consistent, right? So, trading involves risk? Yes. Investing involves risk? Absolutely. But the trading risk is a little bit different in this way, right? So when you're thinking about the two main types of risk, systemic risk, known as undiversifiable or traditionally market risk. It's the standard risk that you can't control, that I can't control, because we never know what's coming next. Now, non-systemic risk, that's the risk that is diversifiable, right? That's the stuff I was talking about with regard to the long-term portfolio. It's the risk that varies from one stock to another stock, from sector of the market to another sector of the market, and it can vary greatly from one portion of the international markets like the U.S. to areas outside of the U.S. in international markets. Okay, so we have these multiple levels of risk available to us, or risk that we have to be at least aware of. And you know, the systemic risk that we speak to most often is the risk that there's something going on under the surface that we just don't necessarily know about. And so while we will be utilizing price action to build risk levels for ourselves, we can't fall back on the idea that those risk levels are absolutely 100% valid, right? We can't fall prey to that idea, okay? All right, next up, managing risk. As I noted, it is absolutely something to embrace, not avoid. So when we talk about managing risk, again, we have to lean into the idea that we are capable of making an improper trade. The timing could be poor or inaccurate, or some semblance of risk comes in that we were not expecting. And so we, again, are recognizing that the majority of our trades are probably going to lose money. Maybe not the majority. In fact, let me just back that up. Let's say about half the time, right? About half, I'd say a good trader is right about half the time. And I think that's a fair assumption. So that means every 10 trades, 5 of them will be profitable, 5 of them would be losers. So our goal is not to take an approach that has us, for example, risking $1 to make $1, because if I'm right only 5 times out of 10 and I make one on all 5 and lose one on the other 5, well, 10 trades down the road, I'm spinning my wheels. I'm not making money or losing money. I'm just not going anywhere. And I want to be able to go somewhere. Like the market, I want to see an upward trajectory to my capital balance. I need to build that balance. So we need to recognize, yes, we're going to take some losses, pardon me. But our hope is that our winners that we have are going to run a little longer and bring us better returns. Now, remember, additionally, we do not have to put positions in their entirety on the table. Let's say, for example, you're a believer that you need to own 100 shares of stock for one reason or another. Back when I got started in the market in the late 90s, that was a common approach. Traders wanted these so-called round lots, but not everybody is familiar or comfortable owning round lots. And then the reality is share total is irrelevant. What matters is the dollars being devoted to any one trade. So we need to be smart about those dollars. And we can also recognize, everybody, that you don't have to put every dollar in on every trade. So if you say my full position, for example, is a $10,000 investment, and that is what I consider to be full position, as, again, example only. But you might feel like, for one reason or another, the stock chart you're looking at's not giving you the warm, fuzzy feeling you want, right? You might have a proper risk versus reward, but for one reason or another, you're uncomfortable. Well, maybe instead of taking a $10,000 position into the stock, you start with 25% of it. And you say, all right, I'll do just 2,500 and let me set my levels based on that. Let's see how that shakes out. If I'm right, I can add to a winning position. How many of you have decided long ago that you're going to be traders who are going to piece into your trades or move out of them portionally? Because one thing that I have learned about my trading process is that when things are, when my profitable positions are going wonderfully, if I start selling a little bit into strength, as an example, like as the stock moves higher, suddenly I'm able to maintain the portion that remains because I have reduced the position and the risk I have on the table. So even though the stock might continue to climb and I might be selling as it moves a little bit higher, I'm able to maintain the majority of the position simply because suddenly, as I've sold off, the risk associated with that position just gets a little less, a little less, a little less. And I'm raising my exit strategy along the way as well. So not thinking about full positions all the time, recognizing that we can be aggressive when we're feeling good. We can about what we see about our viewpoint of the market, our viewpoint on an individual stock. We can choose to be more aggressive at individual moments. We can utilize breakouts as reasons to add to positions. We don't have to be just all black and white. It can be quite a process of gray, where traders just simply say, yeah, I'm going to start small. I'll add. If I'm wrong, my small start will be an even smaller loss than normal. Great. You can just think about the ways you can massage your positions a little bit, everybody. Okay. Next, calculating the trade risks. So here's where we get into the actual meat and potatoes of defining risk on an account-to-account basis. So we've talked a little bit about the broad process, right? Well, let's talk about it from the standpoint of maintaining a portfolio of about $100,000. Now, what we're starting from, don't worry about the balance, just think about the percentage here. The risk allowance in this case at 2% suggests that we should be comfortable with a maximum of $2,000 per position. Okay. Now, some of you would say that's going to be a little high. And if you do the math and you realize that your max risk per trade is more than you truly are comfortable for, well, then cut it down. Don't adhere to a number just because you wanted to start with that number. So we're showing 2% as the example here today. That means $2,000 max risk per position or per trade. That does not mean a $2,000 investment into the stock. What that means, rather, is an investment into the stock that if it moved against you and you bought it at market today and suddenly you were down $2,000, that would be the point at which you would move on. Commonly, we'll incorporate an automated order, the stop order, to move on when our price is met on the downside. We lose no more than $2,000. At least that's our goal. We can't guarantee that with a stop order. I'll talk a little bit more about that. But think about starting from here. Whatever balance you're considering to be your tradable assets times 1% or 2%, keep it small. As we go forward, you'll see why we keep it small. In fact, this is a variation on something we reference, as I've talked about for a long, long time, as the 1% rule. Just adhering to 1% as risk of your total tradable assets. We're going to use 2 as our example, though, today. Now, when we get into the position itself, this is where we start talking about what is the current price versus where the price can go and what level of comfort and risk do we have on the position. So if we were thinking about a stock at $30 a share, willing to risk $2 per share here, well, then we take that $2 per share and we divide that into our maximum risk dollar amount. That gives us a proper position size of 1,000 shares. So let's just reverse engineer that briefly, everybody. If we own 1,000 shares of stock at 30 and the stock drops to 28 and we sell for a $2 loss, the goal here would be to walk away losing only $2,000. Now, again, I can't guarantee that that's the way it's going to go, because when you place a stop order at 28, we have something known as gap risk. So what is the stop order? The stop order is a trigger price. Okay, so the stop order will trigger, in our example, at a trade of 28. And once it triggers at a trade of 28 or below, we have a market order to sell. In a normal intraday market like we have going right now, it's conceivable we could fall from 30 to 28 and a half, to 28 and a quarter, to 28.10, 28.05, and then suddenly we're at 28. We have a triggered order, and then we get a market order to sell. It's likely going to be relatively close to 28, right? But if today we closed at 29, and tomorrow at the open, we open at 25, well, it's that first trade of the day triggers our stop order and becomes a market order to sell. And that means that execution is going to be pretty darn close to 25, not likely to be close to our trigger price of 28. So the stop is not a perfect order. I just have to make that point here for clarity purposes, everybody. Okay. So again, the math is simply you take us taking our max dollar risk on a per trade basis, again, $2,000, and dividing it by the risk per share on the trade we are considering. Okay. Now, next, we're going to talk about my favorite aspect of this, which is risk versus reward. And if you are a frequent viewer of the classes that I do host frequently, you will hear this often, because risk versus reward, I think, is the area where we traders stand the greatest opportunity of increasing our reward at our fingertips. And it's also why, as I stated a little bit ago, why some traders are utilizing the idea of piecing into positions, adding to them after they've achieved a certain level, or starting small and as opposed to starting wholly, right? 100% of your tradable assets. So what is the risk versus reward? Well, risk versus reward is the idea that we're going to try and risk a percentage of what we deem to be our reward opportunity. Now, think back to what I said a little bit ago about how often traders are right. Traders right half the time, 5 out of 10 trades, risking $1 to make $1. We're spinning wheels as we talked, right? But what if that same trader was always risking $1 to make $2 all the time? That was just their process. So if they do that and they're right half the time, well, that's okay. Now we're losing $1 for all of the 5 wrong trades, we make it a 10 trade tranche, let's say, -5 on our 5 losers. But our 5 winners in this scenario, making $2 each, are +10. So here we are at 10 trades, 5 losers, -5, 5 winners, +10. Okay, we're +5 in the pocketbook after those 10 trades because I used a proper strategy. I was either going to lose $1 or make 2. Nothing in between. I'm just going to carry my trade to its natural conclusion. Now, if you can expand that from $1 of risk to $3 of profit, well, now you don't even have to be right half the time. Check this out. Let's say you go on a cold streak. You're not doing so hot. You've in the last 10 trades you've made, you've only been right 3 times. Okay? But you are incorporating a 1 to 3 risk to reward ratio. If the 1 to 3 risk to reward ratio is incorporated and you're right only 3 times, your 3 right trades are $3 each. That's +9. Your 7 wrong trades are -1 each. That's -7. And here we have 10 trades. You've been right 3 out of 10 times, and your pocketbook at the end is +2. You are not only in the green, right? Or in the black, I guess it would be. You're positive after 10 trades, but you were wrong 70% of the time. Now, where can we find a strategy that allows you to be wrong frequently, but be profitable in the long run? That's why risk reward can be helpful. Okay, so let's think about that as we build our actual trades. We're going to look for some specific examples in the market. I've got a couple individual stocks that I found to be potentially intriguing from building a process like this. So risk reward, it can be incorporated by looking at maybe you let's say, for example, you deem your downside level as $2 away. That might mean you're going to go for $4 to $6 in profit. You could also just say, I'm going to look at the technical viewpoint. I'm going to look at the chart. I'm going to check out what I think is support, what I think is resistance, and I'm going to build it around that. That's a good way of doing it for a lot of traders as well. But it doesn't have to be as detailed as the technical analysis side of things. If you're a trader who hasn't yet sharpened that particular tool in your bag, well, then consider just utilizing standard values and working with approximations of risk versus approximations of profit. So, all right, let's look for some examples here, everybody. Like I said, I got a couple that I think could be very helpful for us in providing some context and color on things today. So before I do that, I just want to look at some of these posts we've got in here. Yep. You guys, yeah, some of you are seeing, so like I said, I saw that note about confessions, Ted. I appreciate that and agree with it. Yep, we all just need to be honest with ourselves. Don't lie to yourself. You're not helping yourself out if you do. This is a great point, I think, George, as Ben is pointing out. $30,000 on a $100,000 portfolio where we started talking about the risk factor, right? That is in all likelihood too big a position for many traders. And I agree with you. I don't appreciate the detail that we have in this one because it assumes that we're not concerned about our position size in a $100,000 portfolio. In truth, for a lot of traders, the position size should not exceed 10%, and some traders say even 5% of their tradable assets. So fall back on the idea that you might want to consider that, but additionally recognize what we want to focus on is process, not the actual numbers there. But we definitely agree. 10% down to 5% makes a lot more sense. In this case, that would be $5,000 max position or maybe $10,000 max position in a $100,000 portfolio. It's a very good point, George. I'm glad you brought it up because we don't want to go too far. All right. Now, the examples that I found today, one of them is JD.com. And I found this one kind of notable. A couple of reasons. We have a fairly long run downtrend that began in the February of 21. So 4 years ago already. And it was recently broken right here. And the price action since the break of the downtrend has been a little bit notable. We made a nice pop to the upside and a higher low back here. And this is the weekly viewpoint. So I'm just going to slip on over to the daily. And that's the oval I just placed on all of that action as we broke the downtrend line, right? All right, now let's talk about where we fall today versus where we could find support. If you're a short-term trader, just saying, all right, I like the setup because we broke a long-term downtrend and we've seen some improvement here. Couple of things the trader might consider. We've got a new downtrend that was just recently broken in here. The hope, if you're a bull, is likely that we're just establishing a new layer of price action above the 20-day moving average and the downtrend line. The 20-day moving average is that orange line working its way through the price action here. And so that 20-day could be support. It might be considered support 1 for some traders because it coincides with the downtrend line. Some traders might say, you know what, Kevin, I'd feel better about using the 50-day moving average as my downside target, right? The point at which I'd say, yeah, this isn't working the way I'd hoped. I want to move on. Okay, that might be in another area. So put a little, let's see, let's put a line. Oh, we'll put a line right there. That's right around 37. We'll duplicate that. This line will be at the 20-day. It's about 38. Let's see, what does this say? 38.40, okay? And then there's another layer down below that might actually be even more of a support. The only question is whether we find ourselves there at any point in the future. And that might be the 200-day moving average right down here, okay? Right in this vicinity. And that's at around 33, let's say. Now, why are these levels important? Well, because if you're a trader who thinks that this moving average is the one you want to work with, it's going to greatly impact the number of shares you might be looking for, right? The same thing down here. If your risk is down to $37, it's going to impact the number of shares we can own. If your risk is all the way down to 33 from a purchase at 40, well, now we're risking $7. That's going to mean we have even fewer dollars to invest, right? Not dollars, pardon me, fewer shares that we're going to end up with. So let's use our math that we started with on the initial trade here. Whoops, I didn't want to watch list. I want to switch that over to my calculator. There we go. Okay, so we're going to fall back on our standard math. $2,000 is our maximum loss on the position. And what I'm trying to base this on is the idea that we may have as much as, we got $2,000, and we're going to be buyers at 40 per share on JD here, all right? So $2,000 is our, let me put a scratch pad in here too, everybody. This will be a little bit more helpful for us. There we go. All right. Max, oops, that's one more time. Okay, max trade loss is 2,000. Considering JD at 40 per share. Risk 1 is at, call it, you know what? Let's eliminate the 20-day. Let's try and do this with only these two levels here. Let's go with the 50-day or the 200-day as our approximation. So let's say risk 1 is at $37 a share for $3 of risk. And risk 2 is at the 200-day moving average at 33. Okay? So if the trader is willing to risk $3 a share down to 37, well, how many shares can we own? That, of course, is the $2,000 divided by 3. Okay? And that gives us our total. And then the other one is $2,000 divided by 7. Okay? So, according to my Handy dandy calculator. Oops, I got too many. Here we go. 2,000 divided by 3 tells us we can own 666 shares approximately. And if we use the $7 of risk, we can own a far fewer 285 shares. So this also discusses time frame, right, everybody? If you are a trader who says, I am short-term in nature, you might lean into the 50-day. If you're a trader who says, you know what, I'm going to stick with this all the way down to the 200-day moving average, well, you definitely want to go with a smaller amount of shares. Why? Well, because if we traded below $33 a share, if that's the level you set, you want to get moving on because the potential exists for the stock to trade lower, right? That's what the idea of support and resistance is. Moves through support to the downside imply there is more room to the downside. We don't want to participate in that. We only want to participate down to a level of comfort. So here, 285 shares would be a proper process going down to the 200-day moving average. So now the last thing I'm going to do is just quickly check here. 285 shares times our $40 approximation of price per share. It's on an $11,000 position. Now that actually fits okay. It's a little heavy relative to 10% of the overall portfolio. It'd be about 11.4% for some quick, easy math in a $100,000 portfolio, but we're going to go with it. So let's build that quickly here utilizing our one cancels other bracket process. So that means I'm going to right click on the chart here. And again, we're just going to walk you through the steps, incorporating the bracket as part of the process here. Now, Mark, you're bringing great questions to the table. Let me mention our goal today is to focus on the example and the process. We're not concerned with the underlying position. In fact, JD could be XYZ, but unfortunately I can't use XYZ from an example standpoint anymore, unless I'm willing to talk about block, because that is now the position symbol on block. The point being that we're not taking into account this process for anything more than the process of proper position sizing. How did we come to that position? What was our maximum risk on a per trade basis within the portfolio based on our dollar amount that we're working with? That's what we want to focus on today. Good question, but not pertinent, unfortunately, as it relates to what we're trying to accomplish by building the trade out and then giving ourselves something to work with as we go forward. My goal here is to use this as we go into subsequent classes, and we'll reference this particular trade later as well, so we'll be able to come back to it. So let's go ahead and change this up. We said we're doing 285 total shares, and as soon as I get off of that, all of my details work out. So we're going to go ahead and make this an entrance at market today. Our exit, well, if we're going down to that 33 and risking $7 a share, everybody, I have to be looking to make at least about double that, right? 14 or more. So perhaps I can just use the math. What if I said I wanted to get 20 out of this? Well, then my exit is going to be, why don't we just make it 60? Just as an estimation, okay? We could also estimate an exit up there for some at the prior high, right? So the prior high was around 47, but that doesn't really work wonderfully for my risk versus reward. If I wanted to only target 47 for exit and was buying at 40, I might have no choice but to look at an exit under the 50-day moving average, making it a really tight trade, right? Just think about it like from that standpoint, I think you can understand why in this case, the trader might be looking for a little bit more. Conveniently, the stock has shown price action above even 47. So if this is a new trend developing, the possibility exists that the stock could trade through the prior high and continue going. So we don't know if that's how it's going to play out, but obviously we have our goals, so we're hopeful. All right, so $60 becomes our exit strategy to the upside. And then our exit strategy to the downside, like I said, we're going to use 33. The last thing we're going to do is just make sure that these are set to good till canceled. That is a 6-month calendar period, everybody. And I'll hit confirm and send and send. And now we just had that execution, and now you can see here the brackets that are applied. Everybody, there's my sell at 285, all shares at my $60 limit, or all shares at my $33 stop. Remember, that stop does not guarantee a price. Looks like we had a survey in the chat. Thanks for pinning that to the top, Ben. If you all have an opportunity, I'd love to hear your feedback on the class today. Please take that time, if you don't mind. It's all of 60 to 90 seconds. If you click that link right now, it's going to open in a new browser window for you, and then you can get to it after the session here. We've only got about 5 minutes left, and the last thing we could look at real briefly is Alphabet, which had been thrown back very recently to a layer of potential support, that being the 50-day moving average. Some traders are encouraged when they see a pretty aggressive sell-off. I mean, 207 down to the lows of 187, so it sold down about 20 points, 10% approximately, over the last 2 days following earnings. And some traders might just say, yeah, you know what? If this doesn't make a new low, I'll stick with it right here, exiting under 187 and maybe targeting the prior highs at 207. That's a pretty limited trade, granted, but it could be done very quickly. Buying at market at 191, exiting at 186 would be $5 of risk. And from 191, if it got back to where it was at 206, well, that would be $15 of profit. So that is a $1 of risk for $3 of opportunity on the trade right there. So some might just build that trade pretty quickly. Of course, if you're risking $5 and have a max loss of $2,000, well, we should do the quick math on that. Probably don't want to own more than 400 shares, right? So that's how you might do that, everybody. Real quick, 2,400 shares, 400 shares times $191 a share. That's a bit big. Can't own that, right? So if you do the math and you find that the math dictates that you can own as many as X shares, but when you do the subsequent math and you find that the position size is suddenly 75% of your overall trade assets, my hope is that you whittle that down and you say, no, that's not going to work, because even 100 shares is going to be $19,000. 50 shares would be about $8,500 to $8,600. That's a little more close, right? So what you might sometimes find is that in building your trade, sometimes not all the numbers line up beautifully, and you decide, all right, I'm going to go with my proper ratios. Just because it tells me that I can own 400 doesn't mean I'm going to own 400, right? Just bear that in mind. Always be thinking about cutting things down lower, 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 so that you fall in line with your true comfort. All right, everybody, that's going to wrap it up for us today. This was a fun one. I really enjoyed talking about this, and I tell you, beyond this class, this is a common topic for me when discussing example trades in the classes that I teach. So if you want to see this in practice more frequently, the class that's probably outside of this one most consistently available for it is today's Thursday morning Trader Talk. I am now solo on Thursdays for Trader Talk at Market Open, and my intention is to bring more example trade ideas on individual equities to the table in that class specifically. Now, I do host Trader Talk Monday, Wednesday, Thursday, and Friday now, so make sure that's on your calendar. Big thanks to my man Ben there in the chat answering questions and getting to those for me, and of course reposting the survey. And once more, if you have that opportunity, provide the insights you have on the survey. They come to me directly as well, and I'll be happy to read those comments and try to bring your ideas and thoughts to the table in subsequent classes as well. Follow Ben and me on X, Ben Watson CS, Kevin Horner CS, and if you don't mind, hit that thumbs up button down below for us as well. This is going to do a favor for me in getting this back into the archives and into the YouTube algorithm. Hopefully we can share this particular class with as many viewers on YouTube as possible. So with that, I'll thank you all for joining. Look forward to seeing you all again in another class real soon.